Welcome to the Breakthrough Moments podcast, a podcast where challenges meet opportunities. I'm Harold, and together with my co-host Lasse, we explore stories of innovators, leaders, professionals, and entrepreneurs, and how they turn obstacles into game-changing breakthroughs. Get ready for insights that inspire and lessons that last. Subscribe now, and let's dive into the moments that define success. Welcome to today's episode of the Breakthrough Moments podcast. Today we have Othman with us, and Othman is a passionate advocate for sustainable economic growth, development, and poverty alleviation. He has quite an impressive academic and professional background, including a PhD in finance, but also roles from Citigroup and the African Development Bank. He now serves as the Chief Investment Officer and Deputy CEO of TCX, a fund committed to enabling sustainable lending in the currency of borrowers in developing countries. So join us today to dive into Othman's story, their mission, the vision, and his story. So with that, welcome to the podcast, Othman.
Thank you very much, Harold. Pleased to be with you, and thanks for hosting me.
So I've gotten to learn more about your story, what you guys do at TCX, but for the people that don't know you and what you guys do, could you give us a brief introduction?
I'll try. What is TCX? TCX stands for the Currency Exchange Fund. We have been created in 2007, just prior to the collapse of Lehman Brothers and the financial crisis, for one purpose in life. We have one strategic objective, is to enable sustainable investors to lend and invest in the least developed countries in the world, but instead of investing in dollar or euro, we enable them to invest in the currency of the borrowers. Historically, before the creation of TCX, mainly the development finance institutions, but many more lenders in the advanced world, lend and invest to contribute to the poverty alleviation in the least developed countries in the world, but they were forced to invest in dollar or euro because financial markets are not developed. If they wanted to offset the exchange rate risks, they could not because there were no banks being able to offer hedging solutions, which means that they were simply transferring the exchange rate risk to their borrowers. So in terms of sustainability, it's not the most optimal way to achieve impact because we give financing, but we also give significant risk with the financing that most of the borrowers cannot bear. So the development finance institutions, mainly the European Bank for Reconstruction and Development, KfW, the German Development Agency, EIB, the African Development Bank, and many of these supranational development institutions joined their hands and said, okay, since we cannot offset the exchange rate risk and we have to give it to our borrowers, let's create an institution that we will finance. So they put their hands together and they provided us with the significant capital. And our purpose in life is to provide them with FX hedging solutions to enable them to lend in the local currencies of their borrower. And by definition, we have to sit on that exchange rate risk in our balance sheet. And we are a non-profit maximization company, as you rightly said. We are there to achieve impact and facilitate more investments in the least developed countries, which means that we don't have a profit maximization goal. We want to enable local currency investments, remove the risks from the least developed countries who cannot bear it, and then sit on it in our balance sheet. Our business has developed over the past several years, and we can basically tackle some of the main development since then. This is our main purpose.
Yeah, that's interesting. I remember you gave me the intro and run through of how it typically works currently for the poorest countries in the world, where they have to lend in euros or dollars or a currency where they basically could default given the fluctuation and the inflation and depegging and everything that can happen with their local currency, which basically could put them into this this debt that they never will be able to pay. So I really like the vision, and hence why I decided to I have to bring you on the podcast because I think this is such an important thing to bring out there. But for the journey that you have, there's an ambulance in the background, so I'm gonna let that pause. But you had quite a journey in terms of you had your PhD, then you have Citigroup, they had the African Development Bank, and now TCX. Can you kind of bring us a bit through kind of like the story, like why Citigroup, why did that move to African Development Bank, and then also what made it that the next chapter, which you're in now, become TCX?
That's a great question. After being trained as a finance professional, I wanted to join a large bank when I finished my studies because it's a very good training center. And when I joined Citi back then, I was exposed in many initiatives, mainly in sales and trading in the emerging market world, where basically I have learned not only the theoretical part from the universities, but I really learned how to manage exposure, how to price currencies, the most advanced financial techniques to service the customer of Citi back then. So for me, the starting with Citi has been quite rewarding because I try to put in practice what I learned in theory. It was also a very good training company for the juniors, so I've learned a lot. But after a few years, actually, I have achieved most of what I could achieve back then, and I was sent, I remember quite well, to North Africa, to my home country is Algeria, to try to develop the FX hedging market in Algeria, which did not exist. So we successfully done that with Citi, and I actually liked the experience into not only work on a business as usual product, but try to create a new product to service the needs of our customers. Then from this experience, I said, since I'm quite attracted in capital market development and achieving more impact, the obvious institution for me back then was the African Development Bank, which was based in Tunis. So I joined the AFDB, their Treasury and Risk Management Department, also for that purpose, into using the financial skills to do good in the world, because the mission of the African Development Bank is to alleviate poverty and to use its financial resources and strength to finance the least developed countries in the continent. And Africa, sadly, is one of the continents where we see most of the poverty in the world. So I was quite motivated to join forces with many colleagues at the African Development Bank from different horizons, and to create solutions where nobody else was able to provide.
Yeah.
After 4 or 5 years at the African Development Bank, where I have done a few departments and including the lending, the opportunity came from TCX. And how I got connected to TCX back then, simply because they were doing a roadshow and then trying to convince the multilateral development banks to invest in the capital of TCX to develop the hedging solutions in the least developed countries in the world. So they were falling really into very close to my heart, into what I was quite attracted to do. So I joined the fund actually 1 year after its creation, simply because it's actually the best of both worlds. So we use the most advanced financial techniques to be able to price the risk of these currencies and to manage the risk in the balance sheet that nobody else could take. But at the same time, without a profit maximization goal, we do all of this to do good, to try to enable more lending into the least developed countries in the world on a sustainable manner. And that was something that was quite attracted it was and it still is a very dynamic team from different nationalities and different backgrounds, quite innovative. And that's how we started the journey since 2009 when I joined TCX.
Yeah. And one thing that I'm a bit curious about, like, would the thing that you guys do be possible if it wasn't a not for profit or a not profit maximizing entity? Like, would that be possible if it were a fund that, okay, we want to maximize profits?
That's a great question. I think back then in 2007, it would not have been possible, because we were the first one, nobody else doing what we were doing when we created the fund. And then to be able to prove the concept, you need to generate volume. And then generating volume is the best example. That's the theoretical idea of creating a hedging solution to enable sustainable investment in local currency, translated into a concept that was working in practice, because we have been able to de-risk significant investment in the least developed countries in the world. If we're pricing with a significant spread, then most probably we will not have been able to generate the volume we have generated throughout the years. So that's my first part of the. But at the same time, TCX has evolved since inception. When we were created, we were only onboarding the risks and sitting on it in our balance sheet. But over the past 10 years, since 2015, roughly, we have been able to recycle a large part of our exposure to private investors. And why? Simply because we have $1.5 billion of capital, but we have much more demand to provide our service than what our capital can allow. So we have engaged into two parallel strategies. One is to try to convince the development finance communities, countries, rich world countries, to increase the capital of TCX, which has happened gradually and will continue to happen now with the support of the European Commission. But at the same time, work proactively with the private sector so that we include them in our strategy by recycling the risk that we have in our balance sheets to them. Because many pension funds today, especially in Nordic countries, take Denmark, Norway, Germany, and many other Nordic countries who are driven by sustainabilities. What we do at TCX is something that they are quite interested in. We don't support speculation. We enable sustainable investment in the least developed countries in the world. And we are a non-profit maximization, which means that this is really, we are falling into their court of investment. So that's why a number of emerging market funds who received money from the pension funds have been able to buy indirectly, not from us directly, frontier currencies exposure.
Yeah, so that's interesting. So it started out pre-financial crisis where you got to volume and the majority of what you were able to then offer was based on what money was in the fund. But now the second branch, or the second, let's say, the thing that you just described allows you to increase the footprint in terms of how many countries you're able to help, because you have more, let's say, access to outside capital, but not capital that goes into the fund, but that are basic private investors around the world.
Indeed. I mean, I see it clearly as one of the most successful public-private partnership. I mean, you see today where some of us in Europe tend to be quite pessimistic into the developments in Europe. But if you see TCX, which has been historically a European idea, created in the Netherlands, but then with the support of many institutions around the world, is one of the most innovative ideas that you can think of, which means that Europe is able to innovate and to create solutions that do not exist anywhere in the world for the good. And why it's a fantastic public-private partnership, because the structure would not have existed without the public support, development finance agencies and governments. But then when the idea was proven correct, the scaling up is happening because of the private investors who are taking over some of the risks that we onboard. And then going forward, we clearly see the public sector, the governments, as a catalyst for more support from the private sector, which reaches two goals. One is we become much more efficient in terms of capital utilization thanks to the private sector mobilization. But the most important goal is that TCX should not continue to exist forever. We are an institution that has been created because there is a need. Our purpose in life is to enable capital market developments so that the market takes over, and then every single borrower in the least developed countries in the world will have the choice to borrow either in local currency or in dollar. When this will be available, then basically we can retire with the feeling of mission accomplished.
Yeah. Yeah, that's interesting. And we're going to get a bit into that later as well. But one thing that I wanted to highlight is, and you mentioned that as well, that was that TCX was established just before the height of the financial crisis, where everything comes tumbling down and the collapse of the Lehman Brothers and everything. It was a complete catastrophe for the financial world overall. Like, how do you believe that had an impact on both the, let's say, the run up and start of TCX, but also do you believe that it to some degree have strengthened and been one of the things that have allowed you to get to where you're at now? I'm curious to kind of hear your perspective on that.
Well, you're reminding me of quite a unique experience, and I fully concur with what you said. Well, it was good, but also extremely bad. That basically we created a fund based on a theoretical model, based on historical data that we have justified and convinced the investors to join. But then immediately after the fund creation, we have Lehman collapse. And we lost basically 25% of our equity in terms of mark to market, which is quite substantial if you are an investor, even if you don't have a profit maximization goal. But over the following couple of years, we have recovered all these losses, and then the model has been proven correct. Because what we sold to our investors, existing but also new investor, is TCX is there to absorb the volatility in the market that the least developed borrowers in the least developed countries cannot take. And that's why we need the capital coming from the government and the development finance institutions. So the fact that we created the company, we had large exposure, we have a significant loss, and then immediately after the following 2 years, we recover the loss, was the best proof that the model that we have sold to them works. And we have taken away during these 2 years, which is something that we are pretty proud of, we have taken away losses that would have been taken by borrowers in the least developed countries to our own balance sheet, who can afford these losses. So many countries or companies or individuals who are getting loans in the least developed countries in the world in local currencies, thanks to the hedge that we have provided, did not default because of the large depreciation that happened in many currencies after the Lehman crisis occurred. So we feel quite proud of that, which has basically proven the model, further reinforced the relationship with our shareholders that has led to further support in the following years. And also the fact that we had significant losses proved also the case that exchange rate risk should not be taken by the borrowers in these countries, which is also a very important point that allowed us to fulfill our missions over the past several years, because the risk exists. We might decide to look elsewhere, but the risk is always there.
Yeah. That's interesting. How I said it would be interesting to see, okay, what would happen if we were to do the same, but after the collapse, if it would even be possible to get it off the ground. But it's also interesting how you put it, because I think that's a lot about whatever you do in terms of business, corporate exercise, non-profits, governmental things, an impact that a thing might seem like a negative at face value. But then if you can then push through, it actually becomes a strength. And that's what you basically talk about now in terms of the collapse and the financial crisis allowed you to prove the model maybe even in a shorter time span, or the proof become more extreme and more apparent than what it otherwise would have been. So there's always a positive to it. But one of the things that I'm curious about, and I think a lot of, let's say, people watching this as well would be, and that is the institutions you talk to get the money and get the funds to fund the fund basically. Like, how and what do you believe were the key factors that got them on board? Like, what was it that sold them? Was it the impact part? Was it the innovation part? Like, what do you believe was the pivotal thing that allowed you to do that in the first place? And has that also changed from what in the beginning to what you're, let's say, quote unquote, pitching now?
Yeah, I think the pivotal reason that has led this institution to invest in TCX is really their mission. So if we are supposed to provide sustainable loans, sustainable investments with the main purpose to contribute to the growth in these countries and to alleviate poverty by providing significant resources to these countries, because there are billions who are going into these countries in terms of aid and poverty alleviation. And they are going at a subsidized interest rate, but in dollar. So if these countries will go and borrow from private sources, they would borrow maybe at SOFR, which is the dollar benchmark, plus 6, 7, 10%. By going to the development finance institutions, they might get it at SOFR plus 1 or 2%. So the rates in dollar are quite subsidized. But at the same time, we are giving them a loan. They have been giving them a loan in a different currency. When you integrate the depreciation that these currencies have had versus the dollar or the euro, then actually the loan that they have been providing is not that sustainable and is quite risky.
Yeah.
Every single country in the world, country or even private sector in the least developed countries in the world, they don't generate dollars. They generate local currency. The GDP of these countries are in local currency. We just express them in dollar equivalent. If we give a loan in dollar or euro, and then the country generates local currencies or revenues, there is an explicit exchange rate risk. If you integrate this exchange rate risk costs into the cost of the debt in dollar, actually the cost of that debt can be quite substantial and could lead into default. So we have seen
Yeah.
many countries not being able to pay back their dollar debt, not because they have been mismanaging their finances, but also because they had the wrong financing in dollar
Yeah.
that they could not manage. So when we have brought these arguments together with them, because we are part of the same family, we are also a development finance institutions. EBRD, for example, have been doing significant work into contributing into capital market development, same as IFC. African Development Bank also. We have been talking the same language. It is very close to their hearts to achieve more
Yeah.
sustainable financing, and we have been able to achieve that together.
Yeah. In terms of the reason why they're defaulting and the stories you've seen for that, like, do you have a couple of examples for, like, let's say overarching, like, okay, what happens or what are the cascading effects for a country where they have put on this huge amount of debt in, let's say, 1 to 2% interest rates, which are subsidized, but their currency depreciates according to or comparison to the dollar? Like, do you have a couple of examples of that? But also, do you have a couple of examples of how TCX have helped these countries manage that and kind of like the options they had before and what they've now been able to do with the, let's say, the vehicle for finance lending that you guys provide?
Yes, of course. There is a concept that is well known in the development finance community that is called HIPIC. What is HIPIC is heavily indebted poor countries. HIPC. The heavily indebted poor countries are countries who benefit from aid from the most advanced countries in the world. So there is a lot of aid going into these countries. Over the years, we have seen that cycles of countries reaching the HIPIC stage, there is a debt cancellation from the rest of the world. They go and get more financing in dollar by getting concessional loans, but also going to the financial markets and issuing bonds in dollars. Surprisingly, a few years later, they end up with the HIPIC stage. So basically, it's a vicious circle. Moving from extreme poverty to extreme poverty, and then we have to cancel the debt each time, simply because it's wrong governance. We have seen, for example, last year, Ghana going through extreme difficulties because of the exchange rate depreciation. Zambia has been going into extreme difficulties. Many countries have needed to restructure their dollar debt because they were not being able to pay back their debt in dollar. And here there are two concepts, so that our auditors are aligned to the story. We have to provide these countries with dollar liquidity. That's one point. They need dollars to import from the rest of the world and to finance their infrastructure development. However, this dollar cash liquidity that is needed should not come with the exchange rate risk. That's how TCX come in with the development finance institutions and the private investors to give them dollars that they need to finance their imports and to put it in their balance of payment and reserves, but without a cost at 2%, but at a cost that is equivalent to a local currency loan, so that if there is any depreciation of the currency, they are not exposed to that. The exposure is defined in local currency. So if we take many examples, mainly in Africa, but also we have seen developments in Bangladesh, in Sri Lanka, where countries have faced almost default, if not default, because of significant exchange rate depreciation and their inability to service their dollar debt. Should they have had structured financing in local currency, they would not have faced this situation.
That's interesting. Another thing which is a bit separate from this is that you worked in all across the place, like in Europe, Africa. Like, do you believe that gives you a different perspective on how to approach this, or how do you believe that has contributed in your career as part of TCX since 2009 or since you joined?
I think one point that I have learned through my experience is to be extremely humble. Humility is key. No market is, no country is the same as another country. I mean, if we try to apply the same recipe in each situation, it doesn't work. I mean, we cannot take what works in the most advanced countries in the world and then try to replicate it one to one into some of these least or middle income countries. Each country has its specificities. The cultural diversity that I have through my background, but also through the experience that I have with my colleagues here at TCX, but also through our partners. I hope that it allows me to be able to understand the issues, to be listening much more than basically giving advices or recommendations. And then one final point is, I think we cannot implement what we do without the support of the local community. And the local community is not only the borrowers, but also the local financial regulators, the central banks, the local Ministry of Finance, because you need to understand where are they coming from, address some of the issues that they face, and then be able to work together towards a sustainable solution.
That's interesting. When you, like, for the past decade, like when you've gone to these developing countries and presented like this is what we have, like has there been any difficulties getting them to adopt it, or has it been like, okay, this is something that we've been waiting for and finally we can have it? Like, what's been the experience there?
I would say that the experience has been different on a country by country basis.
Yeah.
We have had countries who understood exactly what we were talking about, and then basically they have been seeking our support to provide them with the solutions, but also in supporting their efforts into reducing the exchange rate risks in their economies. We have seen also other countries resisting substantially. But what we have noticed is that the resistance was linked to the fact that they were not understanding what the product was about. If I go, for example, to one of the countries in Africa or elsewhere who have 90% of their debt in dollars, 90%, and then you tell them, look, I want to help you to have local currency debt. They tell you, no, I don't need it because I need dollar cash. And they are fully right. If they can issue a bond in local currency, they raise local currency, and then to service their existing debt or to finance their import, they still need to buy the dollars to be able to access the international market. Local currency doesn't allow them to service their external obligations. So they have been saying, I don't need local currency. The reality is, yes, they're right, but this is not what we have been trying to address. The biggest added value of the investors, the development finance community, but also the saving that is in the OECD countries, there are large saving that can be mobilized, is to give them dollar, euro, hard currency cash so that they are able to service their external obligations. This we will not stop. It will continue to go into these countries. However, without the exchange rate risk, which means that it comes at a cost, nothing is free. Take the interest rate in euro currently, we are talking about around 3% interest rate. If you go to South Africa, the current interest rate is at 10, 11%. There is a large difference. But the South African government continues to borrow at 10 or 11% because they don't want to take the exchange rate risk. If you provide a solution to a country such as Rwanda, as an example, which is also in Southern Africa, and then they're having debts in euro at cent. If they want to convert this debt into local currency while still keeping the euro, just removing the exchange rate risk, they will need to pay maybe 11 or 12%. So it comes with a cost. Interesting enough, last year, the depreciation in Rwanda has been 20%. The year before has been also quite substantial. So this cost is not for nothing. The exchange rate risk is there. It's been borne by the countries over the years. It's just that it is hidden in their balance of payments instead of making it much more explicit through the hedge.
Yeah, that's interesting. There's one final point I want to go to before I have a very final question to wrap up this episode. And it's addressing a bit of the thing that you mentioned as almost as a side note in terms of the purpose for life in OTCX. Because you have a vision for the fund that is different from a lot of other funds, but also companies in general. So, and that is that you have that goal that within 10 to 15 years, you shouldn't exist. Could you elaborate a bit more on that? You briefly mentioned it, but could you go a bit more into detail? Like, what is it? Why is it? But also, what would quote unquote be the you've reached the goal that the fund is meant to reach?
Yeah, I think it's a difficult question, but our mission in life is to fill a gap. And when we were created, the gap was huge. It's still big, not as huge because we have been able to de-risk 20 billion over the past several years, but there are hundreds of billions being lent to the least developed countries in the world, still in dollar and euro. So, in an optimal situation, is that hopefully in the next few years, there is no borrower either from the private sector or from the public sector in the least developed countries in the world or in the middle income countries of the world if they need a hedge and they cannot find it.
Hmm.
If if we reach a situation that every single dollar going into these countries could be de-risked and remove the exchange rate risk from these countries, then we will have achieved our purpose in life. This could be either through our risk absorption capacity, which is not optimal because then we will be there forever, preferably by having the capital markets taking over what we have been doing
Yeah.
so far. And in the past years, we have seen a number of banks also entering these hedging markets in the least developed countries, which is a very good development. We've seen more investors in the most advanced countries in the world also being interested by buying this risk. So there is much more offer and demand. The market has started to be created. In 10 or 15 years' time, if the volume transacted is enough for the needs of de-risking of these countries, then TCX will not need to exist anymore.
Hmm. I like that. Basically, it's going to change the purpose is once the situation and availability of reducing that risk or removing that risk for these countries is gone, then that mission accomplished basically.
Indeed, indeed.
Yeah, I like that. I like that. The final question I want to ask you, Othman, is we're at 35 minutes now, so I think it is time to ask this question. And I give you a bit of a heads up. I ask this to all guests on the podcast, and I'm always curious to what the answer is going to be. And my question to you is this: if you could get an answer to one question related to what you do, TCX, personally, philosophically, it doesn't really matter what, but a question that you've been thinking about, what would that question you would like to have answered be, and what would you like to know?
It's again a difficult one, but I think what we have been exchanging over the past 35 minutes, as you rightly said, is it seems obvious.
Hmm.
Risk is there, solution doesn't exist. TCX is enabling the market and is ready to be scaled up. The question that I would have is why on earth so many lenders in the most advanced world continue to lend in dollar while they could be taking the exchange rate risk themselves or passing it to us or to the private sector. If you want to be, what does it take to convince all these actors who are in the sustainable finance to simply remove the hard currency lending from the table and only offer local currency for sustainable purpose, which is their mission in life?
Hmm.
If somebody could tell me, because I haven't really found the answer yet, what do I need to do, what do we TCX needs to do, or the development finance community need to do to achieve that goal and to always offer a local currency alternative to a pure hard currency lending, I would pay a lot to get this answer because it would solve a lot of the development finance community issues, but also
Yeah.
help us to achieve our strategic objective.
Yeah. I like that. And let's try to push this episode as much as possible. So maybe someone that has an idea about that could reach out. But Otman, this has been a pleasure. If someone wants to get in contact with you, learn more about TCX, what's the best places to go?
Well, we have. I think TCX is a small company. We have an active website. If there are any questions, you can reach out to us through our website. There's an info email box. Please don't hesitate to reach out to us if you have an exchange rate risk exposure, if you have a question to address, if we need to support your efforts, if our local governments want to develop the local capital markets. We are always there. We are not a private institutions, which means that we don't charge for the service. We're doing it for good. So don't hesitate to reach out to us. And actually, we are a team of 40 people today. At the end of this year, we will be 50. Quite motivated team we have, and I'm sure that there will be many people who would like to support any of our partners.
Yeah, wonderful, wonderful. Then we're going to share that the link to the website is in the show notes and description once this episode goes out. But Othman, thank you so much for taking the time. It's been a pleasure to have you on, and hopefully the listeners and the viewers found some value and found this to be inspirational.
Thanks a lot, Harold. It was a pleasure. It was very nice talking to you.